So I really want to cover four things this afternoon. I want to talk a bit about building an energy business unit and how this Fort Hills decision fits into that and where we see that going. Give you some views on the world oil market that we have and why we think oil is a good diversification for Teck. Specifically on the Fort Hills project, we'll get into that a bit more. A lot of these slides are the ones I say we used on the conference call last Thursday. A quick update on Frontier and then a summary. So this is the slide that Don showed earlier this morning, and we really do think that this mining of oil sands is in Teck's sweet spot. You see the reasons up there, and I'll go through some of those reasons on the next set of slides. The one that's not up there highlighted, though, is the value that the Fort Hills decision brings to the rest of our assets, being Frontier and Lease 421. And as we grow this business, an entry point with the partners that we have at a 20% range, getting that credibility and expertise in this business and taking that through to Frontier and 421 really adds some value for us. Looking at the strategic diversification into energy, we do see a lot of our peers do that. There's a few ways to do that. You can do that in thermal coal, an energy product, or uranium. We've chose to do that in mineable bitumen. We have also some on the other side of that chart. We have some renewables. You heard about the Juanita Dam, and we also have a wind project in Alberta. We are not planning to do any diversification into the traditional exploration production of oil. Sticking with the area of mineable oil sands where we think we can add some value. We know that type of business well, and we think it's a good fit. Again, we operate this equipment in our existing operations. We've got 34 of the large shovels that we'll be using at Fort Hills. We've got over 250 of the large trucks. You saw some of the slides from Ian and the coal business unit and the investments we've been making into this large equipment. As I say, so the exact same equipment that we're using at Fort Hills and we will plan to use at Frontier is the same stuff we're running in our copper and coal business units today. I want to take a little bit of time on the resource that we've been able to build and take a look at the slide of the 3.5 billion barrels of contingent resource that Teck currently has. That's Teck's share. And just make three comments on this slide. Firstly, the Fort Hills number, the 3.3 billion, and that's on a total project share. That is a contingent resource number. We would expect with the sanctioning decision we had last week that when we update our resource estimate for the end of the year, we would see those contingent resources, we would expect to see a recommendation from our independent resource assessor to move some of those contingent resources into proven and probable reserves. So look for that at year end. On Frontier, I've got a slide later on that we are doing a reassessment of Frontier after the lease swap, and I'll talk a bit about that in the Frontier section. So we will be reassessing that 2.8 billion barrels, and that should come out again at the end of the year on a contingent resource basis. Lease 421, we have not declared a resource there yet. We don't have sufficient drilling density to do that, but that will come once we do some further drilling on that project over the coming years, and that will add to that 3.5 billion barrel total. The one key thing is that there's no exploration risk with these barrels. We've drilled these barrels, the ones that we have on the list there. We know that they're there. We have good definition on those. We have mine plans around them, and we can move forward and execute those over long periods of time without additional finding and development costs. Taking a look at these assets in the oil space that have a reserve ratio of 50 years, you can see Fort Hills mine life shown there compared with some of the other large companies in the world and their reserve ratio. And you can see how Fort Hills really is unique with a oil producing resource without decline for 50-year life. It is something that is very rare in the oil space. This is a slide that compares Fort Hills and its investment and cash flow to some other types of oil development, a light tight oil well that you might experience in the Bakken or some of the other plays in North America, an offshore production profile, and then Fort Hills. And you can see the drastic difference on life and the long cash flow that you expect after we get Fort Hills through construction and into operation, and the opportunity to have that project run through multiple price cycles and capture that value over a long period of time.
Sorry, if you're looking for this slide, this one's not in the book.
Oh, thanks, Greg. Sorry. We talked a bit about the cash margin. We do see this as a long life project with good cash margins. We've done a typical project comparison here to a first quartile copper operation. So using a $60 net back price on bitumen with cash cost in around the $25 range, we see a healthy margin on the business, and that's comparable to $3.25 copper price and a $1.25 C1 cash cost on copper. So when we look at these businesses and the margins we get, we see this as a healthy margin business with long life and no declining production. And again, we're taking a look at the projects that Teck has in the Athabasca area. We've got the 3 of them highlighted there. This is a very mining-friendly jurisdiction. I'll talk a little bit more about the royalty regime in a minute, which is part of that. It's also the permitting process that we're going through. It does take us some time, but we do see that that is progressing as expected on Frontier, and I got a slide coming up on that one later on. I've used this slide over the last couple of years, so those of you that have been here in the past may have seen this, and this is how we think about value creation in the energy business unit. And we're taking a series of projects through some value creation steps. And as we move from lease acquisition, where we actually go and bid on a lease and drill it and discover something and take that through to a contingent resource estimate, which we're doing with 421 right now, or Frontier, where we have a contingent resource estimate and we're working through that through the regulatory process and then a feasibility study to get that into a development ready stage. Or Fort Hills, which is development ready, we've made the sanction decision, and in 4 years we'll move that into an operating asset. And Wintering Hills, which was up and running in late 2011 and now is into its second full year of operation. So as we move these projects through these value creation steps, we can see that at each one of them we see significant value being added to the portfolio that we have. And we have them in a nice sequence that we're pressing them at a kind of 4 to 5 year intervals as we move them along that value creation chain. We just wanted to fast forward here and take a look at what Teck's share of Fort Hills would look like once we're up in operation. And this is Teck's share would be 36,000 barrels a day of production. And we just took some Canadian oil producers, their 2012 production numbers, and put them up there to see that the types of companies that we would be compared to on the production basis up there. And you can see that this one project and Teck's 20% share of it gets us into this mid-size oil producing category with this one project coming on stream. And then on taking a look at building out the energy business unit, Fort Hills is certainly our first step along that way. We have Frontier coming along after that, and for illustrative purposes here, we've put 50% of the Frontier production, assuming we bring a partner in at some percentage, and that could be less than that. If we bring in a couple partners, it could be more than that, but for the slide, we put Frontier on there at about half the capable production rate. And then lease 421 down the road once we fully define that resource and move it through the process. So we could be in the range Teck share of 200,000 barrels of production in the next 10 to 15 years as we build out these projects. So I want to take a little bit of time now and take a look at the world oil market. We do see global demand for energy increasing. This is driven by increasing GDP in the growth countries, and this is not a surprise. This is China and India and places that'll move along. And as personal wealth increases, so does their use of oil products. They may not follow the exact trajectory that the United States and other OECD countries have, but certainly they will be increasing on their use of oil as we go forward. And couple that with the depletion rates that we're currently seeing in existing productions, and the world has a big challenge to not only replace that depletion that's happening in the existing oil fields around the world, but also create new sources to meet this growing demand. And that's where we see the real challenge in meeting the world's energy needs. Just some price forecasts from some companies out there that put these forecasts out. They do range, but certainly there seems to be some consensus in that $90 to $120, $115 range for Brent pricing, which is the seaborne price for oil. We do see some possibilities where we could see run-ups in oil price to that 120 or 130 price range, as you know, there may be technical or regulatory delays bringing on production around the world. We think that these correct themselves over 3 to 4 years as new production, you know, finds its way on. We also see the possibility of some dips in pricing, getting down to that $60 to $70 range, and again, that will curtail new development coming on and correct itself in the 4 to 5 year range. So we do see that this is going to be a cyclical commodity as we move forward. And we do think Fort Hills is cash positive through these cycles, and we expect a long-term average, you know, in the range that the forecasters have put there, in that $90 to $120 range for Brent. This slide, and thanks for Greg reminding me about the other one, is not in your book. We got some questions on the call about light-heavy differential and the difference pricing between light oil and heavy oil. So the next kind of 3 slides are going to try to explain the drivers that create a difference in price between a light oil, which is Brent or WTI, and a heavy oil, which is the type of oil we'd be producing at Fort Hills. So there's 4 characteristics here that we're going to talk a bit about, and then try to put them in context when we get to the waterfall chart on pricing later on. First off is light oil has a higher value than heavy oil. You can make more valuable products out of it, gasoline, diesel, jet fuel, and things. So naturally, if you have a barrel of light oil and a barrel of heavy oil, the value in use, or the end use value, is higher for that light oil. When we take a look at the world's production, and we've got a slide coming up next about light oil and heavy oil, we see that there's a favorable balance in the projections we have going forward for light oil and heavy oil, in that we see some light oil is growing and heavy oil is relatively static in the future projections. So couple that with the last point about the conversion capacity, or the ability to take heavy oil and convert it into lighter oil. And so you've got equipment and vessels that are specifically designed to do that. They buy heavy oil, which is at a lower price. They can convert that into lighter oil and end-use products of higher value. That conversion capacity in the world is increasing. So when you have a flat supply of heavy oil and an increasing ability to convert it, we think that the differentials on the light-heavy differential will stay at the narrow end of the range. There'll always be a difference because light oil is more valuable than heavy, but it'll stay at the narrower end of that range of differentials. The next bullet is transportation costs, and we've seen big fluctuations in the light-heavy differential, especially out of Canada when pipeline capacity is insufficient. So the first bullet there is when we have sufficient transportation capacity, specifically pipelines, we see that differential is relatively static and stable, and it trades on the transportation cost differentials, providing the conversion capacity is there, as the first bullet has. But when that pipeline capacity starts to reach its limit, we have alternate routes that start happening. So we use rail, barges, trucking in some cases, and that tends to then increase that transportation differential that occurs in those constrained timeframes. The third piece is diluent. You have to purchase diluent to blend it with that heavy oil to put it through a pipeline. You have to get that diluent, transport it, you have to buy it and blend it in, and those factors all influence the value of that blended barrel at the end. And then lastly is the foreign exchange. These are all priced in US dollars, and of course we have a marker in Canada that we'll talk about in a second that's priced in Canadian dollars, so there's a foreign exchange to take into account. So this is the chart that looks forward, and I'm going to try to explain this. So The graph you see on the left first is the historic discount of Brent on heavy oil. So it shows that over the last little while, the discount has narrowed considerably down into that $20 or 20% range. If you have $100 oil, that's $20 coincidentally. So it's come down in 2012 to be relatively narrow from where it was quite wide previously. The two graphs on the right side show on the top the projected composition of the world's oil. So on the bottom, the dark bars on the bottom are the heavy oils in the world, and the blue bars are kind of the medium weight, and the lighter colors on top are the light oils in the world. And you can see that the production of heavy oil, the black pieces on the bottom and the blue, are relatively steady as we move forward in this forecast. If you go to the bottom of that chart, this is the capacity in the world to convert that heavy oil into lighter oil products. And that capacity is growing, or forecast to grow, over that period of time. Those taken together should mean we have sufficient capacity in the world to process the heavy oil that we're producing, of which Fort Hills will be a part of that, and convert that into light products. So we won't have the ability, a situation where we do not have that conversion capacity to make that work.
What's vis breaking?
So there's a bunch of different ways to change heavy oil into light oil, and viscosity breaking is one way to do that. It takes the long chain hydrocarbon that breaks them down. Coking is another way to do that, where you actually extract carbon out and you leave a lighter product. So it's just different ways of doing the same sort of thing, taking a long chain hydrocarbon and breaking it down so it's changing its viscosity so that you can actually pump it in a pipeline or use it as other products.
Thank you.
And this slide is also not in your deck. And this is historically taking a look at two things. On the vertical is the light-heavy differential, and on the bottom is the price of Brent. And on the bottom line of that little triangle you see there is the value of conversion. So if you have conversion capacity available, that's the line on which we would expect to see the light-heavy differential trade. So that's the real value difference. So if you have $100 oil and you go up and you hit the bottom line, that comes at a cost of about $20 for the differential. That's if you have capacity to convert it. If you don't have capacity, so you don't have enough capacity in the world to convert heavy oil, then you go up to the top line, which is the substitution line, where heavy oil then has to push into the power generation business or be used for some other purpose. And that's where you have a higher discount. So that's where that conversion capacity in the world comes into play. We're forecasting there is sufficient conversion capacity, and we'll be trading, you pick your oil price you want to use, but that bottom line then would give you what would be a reasonable light-heavy differential based on the cost of conversion of that into lighter oils. So we're back on slides that are in your book. So when we talk about the U.S. production, forecast to grow from about 10 million barrels per day right now up to about 17 million barrels per day by 2030. And this is a real revolution in the U.S. production, and it's really being driven by light, tight oil. And there's lots of speculation about, well, will this force Canadian heavy oils out of the market? And when we look at that, this domestic production, the first thing it's going to do is start replacing light oils that are being imported into the U.S. right now, because this light oil that's coming in will push the similar types of oils on the import basis out of that. And when we look forward, we still see the U.S., which has a big conversion capacity built in, will still be relying on imports of heavy oil and to run those refineries, to fill those cokers. So we do see that the U.S. will still need heavy oil from Canada, and we do think that light heavy oil differentials, as the last bullet that says there, will stay at the narrow end of the historic range. Here's CAP's forecast on Canadian oil production, and you can see that's being driven by oil sands growth. This one is been out for quite a while, so I won't spend too much time on it, but it does indicate significant growth. CAP tends to be fairly optimistic on their numbers, and those are pretty high. But we do see strong growth coming out of Western Canada. The key takeaway from this rate is that this is the last bullet, which is oil sands is still expected to keep growing up into that 5 million barrel a day range by 2030 from about 2 million barrels a day currently. So we do see some robust growth coming out of Canada. So So we want to take a look at the capacity of the market currently in the world to take that heavy oil. And this is a graph that shows the ability, first of all, in the blue bars of the US in 2012 to process heavy oil. And you can see there that the blue bar is quite high. They could process at least 3 million barrels of heavy oil coming into there. And the line, the horizontal black line, is kind of what Canada produced in heavy oil in 2012. So there's certainly sufficient capacity around to meet that heavy oil demand. If we fast forward to 2020, and if the CAP forecasts come true on heavy oil production increase, and we forecast where that conversion capacity is going to be built in the world, we see that we've reached the upper end of the US market for conversion capacity, and in fact may have exceeded it depending on where we go. So we will need to get some of this heavy oil into other markets, specifically Asia, to convert it. And that's really what that graph is trying to say, that there's we need to start by 2025, mid-next decade, exporting oil off the continent to take advantage of that conversion capacity. So just to summarize on the oil production and marketing refining side, we do see forecast production through 2030. The U.S. is the largest complex refining area in the world. It does have the ability to take in large volumes of heavy oil and convert that. The heavy oil refining capacity in the continental U.S. Has grown a lot in the last little while, and we think for the next foreseeable future it can handle oil sands growth. By 2025, we do need to access offshore markets to continue to grow the Canadian oil business. And Asia is the most likely source of where we'd like to move that product to. I want to move specifically to Fort Hills next and take a look at that project. This is a large truck shovel project. As we've talked about, we have a 20% interest. We do have very strong partners there in Suncor and Total. Suncor is the operator. This is a world-class resource, over 3 billion barrels of recoverable resource with a 50-year project life. The robust economics, we see this as a cash-positive project through the cycles of price as we see them. And we've got multiple options for marketing and logistics, some of which the partnership has landed on already and some of which we'll still need to work on. But the footnote at the bottom there is one I started with, is the knowledge and capabilities that Teck gains out of this Fort Hills partnership is going to be the foundation for creating value in the rest of our oil sands assets. This is a chart that shows a couple of variables. So on the bottom is, think about it as strip ratio. It's actually total volume to bitumen place, but it's the way the oil sands guys take a look at strip ratio. And on the vertical axis is the grade in weight percent of bitumen, and the size of the bubble represents the size of the resource. And of the undeveloped mineable resources, Fort Hills is the best. And we see Frontier up there as well for our comparison basis. This will give us about 13 million barrels of production a year, Teck share, once it's running up and running. And some statistics there on startup, fourth quarter of 2017, and we expect to be at 90% of planned production about 12 months after that. Just taking a look at the capital cost on a fully escalated basis going forward from sanction, so that was 5 days ago, we expect a $13.5 billion spend. When we take a look at Teck's share of that, our 20%, plus the remaining earn-in, we have $2.94 billion going forward over that same period of time. We've got some metrics on operating costs and sustaining. So we've got a total operating plus sustaining of the $25 to $28, and we've got sustaining in at $3 to $5. That's included in that, and this does not include the purchase of diluent to blend with the bitumen for transportation. If we take a look at all-in costs, so the cost since we restarted the project back in 2011, on a capital per flowing barrel basis, we get $84,000 per flowing barrel. That's the bar shown on the right on the graph there. And we've got two recent similar projects that have been completed and are in operation in Athabasca. And you can see that the $84,000 per flowing barrel on an all-in project basis, we think is quite similar to other projects that have been executed. You heard Ron talk about the strong cash balance sheet we have. We do have a strong cash balance, and we can finance this through free cash flow from our operations, our cash balance, and we do have a $2 billion unused line of credit currently. I want to talk specifically about execution risk, and Suncor has put a lot of thought into how we're going to manage and execute this project. So we do have our regulatory approvals in place to start construction. In fact, we had the first pile being driven in the ore preparation plant here last Friday. So we're on site and we're building. We do have a focus on a cost-driven schedule, and that we are focusing on building this efficiently, specifically with labor, on-site labor efficiently, as opposed to faster. We have a very disciplined engineering approach in that we're not going to release packages for construction until we reach the detail of engineering we need so that we can execute well in the field. We do have a shovel-ready site. We have like a 500-person camp on site ready for occupation right now. We've done a lot of clearing. We've got roads built on site. We've got the river water intake being built. So we have a site that is ready to start construction. We are sourcing our engineering and supplies globally, and we're locking in those supply contracts as we speak so that we can give us some price certainty on labor and materials as we go forward. We've planned an efficient manpower profile in that we're trying to keep the on-site labor to 5,000 or 5,500 people, and we feel that that's the sweet spot for getting the project built, but keeping your on-site labor productivity high, which has been a problem on other projects. And we've spent about 15% of the capital already getting the site ready to get started. So that's also de-risking the project from this point forward. And just to reiterate a point Don made earlier this morning, Suncor has completed 4 projects of about $20 billion, all at or under budget over the last 5 years. So we are benefiting from that Suncor experience, and we think that this area is being carefully planned and thought of. On Teck's marketing options, we have a wide variety of options from marketing the bitumen product ourselves. We do have experience marketing complex products around the world with our coal and base metal marketing teams. We could get some additional support from consultants. There are several of those companies that provide that support in the Calgary area. We could go out to a third party and contract out the marketing for us for a period of time, or we could use a hybrid of that. We will take a look at this and make a decision here over the next couple of years as we go forward. We've got 4 years from now until we actually get our first product coming at us. This is the waterfall chart to help you figure out how we think about netbacks, and this is just an example of a $100 WTI price on the waterfall, and just takes you through the steps: transportation into Cushing, Oklahoma, where WTI is priced, and then going from Cushing, Oklahoma all the way up to Hardisty, Alberta, where Western Canadian Select is priced. Western Canadian Select is a heavy oil. WTI is a light oil, so you have the light-heavy differential. You also have the Canadian-US dollar exchange, and you have some transportation costs to get there. And then from Hardisty, where Western Canadian Select is priced, you have to back that back up right to the mine gate, and then you have some transportation costs, slight quality adjustments, and the diluent purchase that you have to make, and then you get a net back of bitumen at the mine gate. And that's really what that's trying to show on a typical example. And a typical barrel of Western Canadian Select or a Fort Hills blend is about 25% diluent and 75% bitumen. And with that blend ratio, then you can pump it through the pipelines. So Teck will be taking a look at securing transportation facilities or capacity to get us down through the Chicago area and probably down as far as the U.S. Gulf Coast, which is a large market potential for Fort Hills production. And the methods to get to those markets, we have common carriage pipeline where you show up with your barrels 1 month and they take them for a fixed price. They're a contract carriage where you have guaranteed capacity, where you can sign up for anywhere from 10 to 25 years on a take or pay basis. There's also rail options that people are taking a look at for niche markets where they're not serviced well by pipelines, or you're able to extract a premium because you can get your product there. It could also be an option for us, and we may use a combination of those as we take a look at our marketing options. So Teck has, with its partners, landed on some solutions already. So we are purchasing diluent from Edmonton. There is a market for diluent there that's priced. We have, with Enbridge and our partners, got a diluent pipeline plan to get to the project. We will then blend and cool the diluent, the bitumen with the diluent, and we do have a pipeline planned with our partners that takes the blended product from the mine site to Hardisty, Alberta, which is a point of common carriage that we could then go on to take our share of bitumen and move it ourselves down to markets, as I said, in the Chicago or Gulf Coast areas. And just when we take a look at those projects that are coming up, here's a suite of projects that are happening currently, and this isn't all of them, by the way, that are happening right now. The ones that we have the blue banners on are either in construction or should be starting fairly soon. I think it's brown or darker colored banners are still going through the regulatory and approval processes and may come on a little later on. There's a couple I'd like to point to. One is the southern leg of Keystone. That is in construction. We'll start up running next year, and we're taking oil from Cushing, Oklahoma, down to the Gulf Coast. And that's an area where there has been some price disconnects in the past, and that additional capacity is going to help keep the linkage between Brent pricing and WTI pricing based on reasonable transportation metrics. The other one is the main line or the common carriage project that Enbridge is doing from Hardisty down to Superior, Wisconsin, and increasing the capacity of that main line through there. And that's also not talked about a lot, but adding pumps and pipes on that is adding several 100,000 barrels a day of production out of Alberta. This is the solution that the Fort Hills partners have landed on. So we have a hot bitumen pipeline that comes from the project down to Suncor's base operation called the Suncor East Tank Farm. From there we have tankage. We'll cool and blend it, and we'll go down the Wood Buffalo pipeline and then down through the Fort Hills blend line all the way down to the Hardisty terminal. From Edmonton we have a pipeline for diluent coming called the Norlight pipeline that comes back up through Cheecham and enters back to the Suncor's East Tank Farm for bringing diluent up to the project. So those agreements have been put in place. All the partners share equally as our percentage ownership in using those and have the same transportation service agreements with Enbridge. I'd like to spend a little bit of time on the mine plan about Fort Hills, and we haven't talked about this that much, but the black number 1 you see there is the South Pit. It's designed at a little bit lower cutoff ratio. It does a lot of things for us in the early development. One, we have good early economics on the project, so a lower strip ratio, a good quality resource. But even more than that, as we finish that pit in the first 10 years of production or so, we then can move out into the number 2 area, and that becomes a containment area for our tailing storage. So without building dikes, you can actually then use that for very quick tailing storage capacity to get your tailings being stored in pit, which is beneficial. And northern pit carries on then for the next 40 years, mines through a sequence, you can see it there, and is to a higher cutoff ratio of at 16:1. And then gives us the next 40 years of life. We have a very robust flow sheet shown schematically here, a couple of crushers, 3 ore preparation plants, 2 separation vessels, and a 3-train froth treatment plant. One of the things I would say is that the primary extraction and ore preparation plants are based on exactly what Suncor is using in their most recent plant construction right now. So we see very little either execution risk or operational risk at the front end of this plant at all. The paraffinic froth treatment process produces a premium bitumen product, and it is the process that the newer mining operations have employed. So this is some of the slides that I just was talking about on the graphic there. The extraction plant is based on Suncor's existing technology and based off their designs, plus the improvements they've made to that design recently. The froth treatment process is on a paraffinic froth treatment, which does produce a premium marketable bitumen product. And we think the plant configuration gives us good bitumen recovery, good reliability, and a high quality product. I wanted to talk just a little bit about royalties in BC, and I mentioned this earlier about a mining-friendly jurisdiction. There's a two-phased royalty system in Alberta. I might have misspoke there. It's in Alberta, and the first phase is in a capital recovery phase. So you have a lower royalty, varying between 1% and 9%, depending on your WTI oil price that you find yourself in, and that's a linear scale between $55 and $120. So you're at that low royalty until such time as you get your capital recovered, and that includes recovering capital with some interest tied to the long-term bond rate. So you're in that first phase of royalty until such time your capital recovery is complete. Then you move to the second phase of the royalty regime, which again is a sliding scale based on price, and it's based on 25 to 40% of your net revenue. So you get to net off your operating costs off of that. Tailings management plan, it's critical that you do tailings management well. We have Suncor's experience to rely on. They have put a lot of effort and work into managing tailings on site, and we think we've got a plan that is compliant with the Alberta regulations. And just summing up, we think Fort Hills is a great value proposition for us. It's we're with Suncor, a very experienced operator. We have the best undeveloped mining lease in Alberta. We have a multi-decade asset life, solid project economics, and it does build our energy business unit for the future.
Ray, I think we should hold off on Frontier for...
Absolutely, we can do that. If you want to take a few questions, okay, whatever. I got 2 slides, Greg, if you want to do that. And
touch on those, the ones you want to touch on. And,
okay, so this one we've seen before. Frontier is in the regulatory process. It's a big project designed for 277,000 barrels a day, 2.8 billion barrels. Produces the same product, by the way, as Fort Hills does. I want to talk a little bit about the enhanced configuration that we've agreed to with Shell. We've swapped some leases. The blue one at the bottom, which is labeled Equinox, we have given to Shell, and all of the leases in the light green that are adjacent to the Frontier lease, Shell has given to us. This has really enhanced the configuration of both Shell's project and ours, that we can execute these without it being too much interference with each other. So I think that's very beneficial. It's going to help us through the regulatory process as well. The other thing that's even possibly of greater benefit down the road is our mutual access agreements and the project agreements, where we can take a look at regional infrastructure that's required for both projects, and we can do that on a way of saying, you know what, how can we both design something that both projects can take advantage of? So we're very excited about this. We think it's a big step forward for Frontier. We are redoing the contingent resource estimate based on this new configuration, and we should have that out by the end of the year. And we have the regulatory process is on track. We filed our responses to the second round of information requests just last week, which is on schedule. And we would expect a hearing in 2015, maybe slipping into 2016, and approval following about 9 to 12 months after that. And we have talked a couple of times about exploring some partnership opportunities as we approach that regulatory approval milestone. And that's it, Greg.
Great, thanks very much. I know we're a little over time, but I think we should take some time for questions here. I suspect we've got some people who have some interest, so if you want to put your hand up, we've got a question over here.
Thank you. Right now is the only real political risk the northern leg of the XL pipeline, and what does that do to costs if it doesn't go through? Are there any other political pipelines that are a problem?
Certainly, Canada needs pipelines to capture full value of its production. So we need some pipelines to go through. One of the things we're trying to show with one of those slides is the northern leg of Keystone is one option. We have Trans Mountain, the expansion. We have Energy East. We do have the expansion of the Enbridge Common Carrier Line down to Superior. So we need some of those to go to really capture that. So if Keystone Northern Leg doesn't go, is that the end of the business up in Northern Canada? No, absolutely no way. But if it does go ahead, that'll be a big, it'll almost be as much psychological as it will be material, because it'll be one that it has been in the press a lot, and will kind of give, I think, people a lot of confidence that we're going to have the takeaway capacity that we need. But We think that there will be pipelines built. There will also be alternates. The increasing use of rail is also taking a lot of product to markets as well. So we think solutions will come as we build this project out over the next 4 years. And we're going to look for those opportunities here now that we have a sanctioned project that we can tie those decisions to.
Great. Couple of questions. In one of your slides, you have Capex timing for up to 2015. It says here it's almost 30%, and then 20%. What's the distribution of the Capex over the next 4 years till you reach production?
Yeah, so we're looking at $13.5 billion for the total project starting at sanction. Some of that, a little bit of that's going to be spent in November and December here this year. But then when we take a look at the next 3 years, like 14, 15, and 16, I would see those as being fairly smooth, about the same. And then 17 is going to drop to about half of that, because about halfway through 17, we're actually going to be starting commissioning activities and startup. So the bulk of the construction is going to wrap up mid-year 17, and then we're going to be in the commissioning and startup as we head towards first oil. So if you looked at that kind of, and if you broke it into like 7 segments, 2 and 15, 2 and 16, sorry, 14, 15, 16, and a half year in 17, relatively smooth across that profile would be a good model to use.
The other one, just really
Go ahead.
quickly. In your estimation, you said the differential $20. How does the new or potential new production coming from the Gulf of Mexico is factored into your assumptions? Say Mexico privatizes their oil and gas industry. How does that work in your assumptions?
We've seen Mexico and Venezuela declining recently. If they revitalize those industries and can get them growing again in production, does that compete at the Gulf Coast? Certainly it does. But when we take a look at the world in total, we think the world's going to need all of this oil, so it's going to find a home. And we believe that oil is going to be in that kind of $90 to $110 range, regardless of if it's coming from Mexico, Venezuela, deep offshore Brazil, or wherever. So we think that the world's going to need this oil. We think that the price curve is going to support a price in that range. And will it compete at the Gulf of Mexico? Probably will. That may push us to get offshore more for the Canadian production in the longer term, but we think that's also going to manifest itself into the next decade.
Ray, how's your cost structure impacted if you decide to market it through a third party? Is this a percentage or a dollars per barrel?
There's a bunch of ways we can do that. We haven't explored that yet, but a lot of them are kind of a per barrel plus an incentive fee or something. So we may look at that just to bring some expertise in first, but we may also be able to go out and hire some of that expertise into the organization as well. We have not made that decision yet.
How should we think about phase 2 and phase 3 for Fort Hills? Like, when do the partners plan on doing the conceptual studies, the regulatory approval, so forth? And is there incentive to just keep pushing the expansions ahead to defer off this progressive royalty as long as possible?
I think there's actually a big incentive to debottleneck a project. And one of the things that a 50-year project life allows you to do is take advantage of those types of opportunities after you're up and running. The resource certainly has the potential to be expanded. The partners have not decided when that's going to happen. We certainly have allowed for the possibility of that happening. But there is a process that has to go through. Currently, we have approvals to go to 190,000 barrels a day. That's what our current project is approved at. So if we were to go above that, we'd have to file an application for that, go through that approval process, and then build it and go there. So that's going to take us, pick a number, 7 to 10 years, even if we started today. So this is a long life asset, 50 years. We have the ability to debottleneck and grow the capacity down the road. My personal belief is that's going to come after we start up. You see where the debottlenecks are. You're much smarter with exactly where you want to put your capital, and that capital is very efficient when you actually deploy it for growing additional production. So it's going to come later in the life of the project, but it's going to come at some point in time, and the partners have not decided what that looks going to look like yet.
Thank you.
Jorge here with Deutsche Bank again. I'm just trying to understand, this project represents about 15% of your potential barrels down the road. I think you can get to about an 85, 90 million BOE. And it looks to me like if you were to gross up the Capex just going from this initial project, you're looking at a potentially $20 billion Capex investment over the next 20 years. So I'm trying to understand ultimately how do Teck shareholders get money back from these projects? Would there be a commitment to start dividending back a portion of the earnings or something, or will this be a continual recycling of that cash flow into the oil business?
All the future decisions, of course, Frontier being the big one coming after that Teck's in control of the timing and when that goes forward. So we're gonna have to see how Fort Hills plays out and how that goes along, and what other projects Teck has at that point in time before we make that investment decision. So I can't speculate on kind of what the world's going to look like at that point in time with commodity prices and copper and coal and prices and whatever else, and what that's going to look like. But those things will need to be factored into our decision as to when we go ahead with Frontier and what partners we've been able to attract to that project with us and what percentage we actually have left to do and what the costs are going to look like. So.
Thank you. In shopping for partners down the road for Frontier, will you look only for capital partners for the big bucks, or would you try to give a few percentage points to a heavy oil conversion partner or a pipeline partner, a la Escondida, having a few points for the refining?
Good question. Thank you, John. I think we're going to look, first of all, with a partner that fits culturally with Teck and is a good fit for us in the partnership. We're going to want somebody that can certainly contribute financially to the project, but we're also going to look for somebody that can contribute beyond financial. So whether that's in oil processing expertise, whether that's in pipelining, whether that's in upgrading, marketing, and use of the end product, I think would be also things that we would look at when we make that selection.
Right. And thank you very much for spending the whole afternoon with us. We appreciate your dedication, your time, and again, the survey that you have in your desk. We'd appreciate you getting back from you. You can turn it in at the front desk. Ellen will give you a gift regardless of whether you actually give her the surveyor back. If you feel rushed to do it, certainly you don't no obligation to turn it in today. If you want to email it back to us or however, we would appreciate getting it back from you. We do have a reception time lined up for more personal interaction Q&A time in the foyer again where we had the coffee break. Oh, sorry, yes, thank you. Laurie's correcting me. We're on the 9th floor, so sort of same ballroom corner, but down on the 9th floor, just down the stairway out there. So again, thanks very much for attending, and look forward to talking to you all soon. Thanks very much.